Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, what a roller coaster shares of SMCI have been, up 130% in less than 3 weeks, then crashing back 30% in the space of just 10 days, even after reporting financials that are going to keep it listed on the exchange. This is an investment I was up over $500,000 at one point, but even after that pullback, still up over $248,000 on my position, and with an SMCI stock update to show you why I bought more shares last week on that drop. I'm going to outline everything that's happening, why the stock is falling, the bull and bear case for shares of Super Microcomputer. Stick around though, and we'll also cover important updates to SoundHound AI, Costco, and all the stocks I'm watching this week, along with what's happening in the stock market. Is it a buy the dip opportunity, or should you be waiting for something worse? First, onto our main topic though, and the lead up to Super Microcomputer's business update February 11th, and then its Nasdaq filing deadline on the 25th were intense. Shares jumped 130% from early February through that update on the 19th, when investors started to worry that delisting was still on the table. Even after SMCI filed its latest financials though, and proved it would avoid delisting, the stock has continued lower and is now down 32% in just 2 weeks. I've been buying here since September and started aggressively adding shares at the bottom under $20 each in November. At that February rebound, my position was up over $500,000 on 19,500 shares for more than $1 million in SMCI alone. On the pullback though, the profit has shrunk to $248,000, and you can see I've started buying in again, now at 22,500 shares. Now here I want to cover the new risks and issues rather than rehash the analysis on the allegations from last year that got us started investing in the shares. So if you want to see that, check out the video linked in the description below for that earlier analysis. An internal investigation and new auditor both found the allegations without merit, but there are obviously new risks driving that 32% plunge that we need to consider here in this update. We'll also look at analyst targets as well as my own price target for SMCI. And first off, the recent weakness may not be as company specific as it appears. If you look at a chart of the SMCI and its wrenching 22% drop last week against the tech-heavy Nasdaq index here, and especially the AI darling Nvidia, you see a very strong market influence. Obviously, the scale of the drop is much larger for SMCI, but this chart for NVDA, down almost 10% last week, especially the big intraday dips, aligns almost perfectly with shares of SMCI. This implies that a lot of that sell-off is simply broader investor sentiment for AI taking a hit, rather than uncertainty and risk in Supermicro. Some have also tried to blame the selling on filings to sell shares by two directors, co-founder Sarah Liu and Senior VP of Operations George Cao. The two filed regulatory documents last week to sell approximately 118,000 shares, worth just under $6 million. The thing is here, officers often sell shares to de-risk their dependence on a company, and both here, including Liu's husband, CEO Charles Lang, continue to hold large stakes in the company. I mean, this is a company where the insiders own 15% of the shares, which is very large for this size of a company. With the uncertainty around the stock over the last years, directors probably haven't had that chance to sell as they normally might for fear of causing a panic, so I wouldn't be surprised to see more sales coming through over the next month, but wouldn't be worried about it here. Besides that broader market sell-off, a lot of the post-filing crash is also likely just hot money coming out of the stock. SMCI was the volatility stock over the last 6 months, attracting a lot of traders betting on or against the shares. We had a set date for a catalyst, which is rare for traders to have that kind of a set date, and they were loving the daily action. This is a stock that saw 100 million plus shares traded daily in 12 of the last 13 days, against an average closer to just 30 million shares traded on a daily basis in normal times. With the companies filing to avoid delisting, a lot of that uncertainty and the volatility comes out of the shares, and I suspect a lot of that hot money is selling out. Surprisingly, there's been little talk of what I see as the only real remaining risk here, the investigation launched by the Department of Justice, the DOJ, last year around those short seller allegations. Management has said that it's cooperated and answered questions from the government, and we could get an update on that anytime. In my opinion, this is the only big overhang on the stock. Now, I doubt the DOJ is going to find anything material that the company's internal investigation and the new auditor missed. And we can assume that the new auditor, BDO, would be exceptionally vigilant in its audit, given the allegations and the company's history. The Department of Justice is most likely concerned about those allegations that the company was skirting export restrictions to Russia, but it'd be difficult to prove complicity by management in any of those shipments. News on the investigation is a risk, but any penalty or fining is likely to be a non-event. It's going to clear up that last remaining uncertainty to help to send the shares higher. Now, against this reality, analysts have come out cautious on the stock even after that filing, and with only Loop Capital rating in a buy. Goldman Sachs analyst Michael Ng did acknowledge the company's lead in the server and storage systems, but sounded a warning on profitability, saying SMCI is very well positioned to serve demand from AI communication service providers over the next few years, but serving enterprise AI infrastructure demand in the years after likely will be more competitive, particularly given the more enterprise-focused IT hardware suppliers such as Dell and Cisco systems. Barclays also in a post-filing report acknowledged the company's superiority in those AI servers, but said too much risk remains to give it a buy rating. Here we see Goldman's price target of $40 a share is just under the average $45 target among 8 analysts, with a low target of $15 by Susquehanna and a high of $70 a share by that Loop Capital. While it does rate the stock a hold, Barclays still gives SMCI a $59 price target, 44% upside from Friday's close. Now, my own price target here is based on expected sales and valuations closer to the company's historical average. While CEO Lang talked up the possibility of reaching $40 billion in sales next year, the market is still only expecting $33 billion, but still a very strong 38% growth from expectations for $24 billion in this year's revenue. And here, analyzing the larger trend and the industry, while investors have been generally disappointed with guidance from the chipmakers like Nvidia and AMD or server competitors like Dell, we've gotten confirmations on that massive data center spending by Meta, Amazon, and Microsoft, and with SMCI's leadership in that high-performance server space, you should be able to at least meet these expectations. With investor sentiment weakening on those AI names, I don't think we get back to the 6 times price-to-sales valuation we saw at the peak last March, but the company has traded around 2 times valuation multiple for much of the last few years. Even in the uncertainty of the past 6 months, shares have traded for between 1.2 and 1.7 times sales. Applying these multiples to sales forecasts for $24 billion this year gives us a range of between $29.5 billion market cap, that's a $47 share price on the 1.2 times valuation, to a $48 billion market cap, a $77 share price on the 2 times valuation multiple. And I think this is still a conservative estimate. If you look at the price to sales valuations here the stock has traded at in the last year, and the market's forecast for that $33 billion in sales next year. Looking at some of the stocks I'm watching this week, SoundHound AI, ticker SOUN, jumped 16% Friday on its quarterly earnings, reporting 101% revenue growth and guiding to continued growth. This is a stock I recommended a year ago, around $5 a share. While it has pulled back from that jump to $25 each, this company is still one of my favorite long-term growth stocks. And we've already seen SoundHound sign several large partnerships to run its voice assistant AI in cars across Europe. And last week, we got more detail on its biggest opportunity, launching a call-to-order system for drive-thrus across the United States. The system is in more than 10,000 restaurants across the country and enables users through the AI voice assistant to seamlessly order their food. As we saw Friday, the market agrees that this is a giant opportunity for a relatively small $4 billion company, helping to double revenue growth every year. Advanced Micro Devices ticker AMD just keeps falling, so I wanted to update it as well, with the stock down 14% since I started buying mid-January. Now, a lot of this is just that AI sell-off, with shares of Nvidia down 14% this year as well, and the broader Nasdaq tech index down 4%. I've been vocal about buying AMD, so I wanted to reiterate that this is still one of the best values in tech. Despite that near-term weakness, the company still grew sales at 40% annual pace to the last quarter and is about to launch a big product upgrade in its 300 series. On full-year growth of 23% to $32 billion in sales, shares trade for just 5 times on a price-to-sales basis. That's ridiculously cheap for a stock with this kind of growth. Now, folks, this is a patient stock. It's something that we've seen before in stocks like SoFi Technologies and even SMCI there. There's none of that AI bubble built into this stock like many of the others that we see, and it will head higher. I'm also watching Costco Wholesale, ticker COST, reports earnings on Thursday, and while it will be an important read into the health of the consumer spending, it might also be a surprise upside from what we've seen in those other big box retailers. Shares of Walmart are still down 5% after plunging when it warned during Q4 earnings that consumers might be pulling back a little bit this year. But that pain at Walmart could be Costco's gain. Blowback from removal of DEI programs at Walmart and Target have contributed to slower foot traffic, with weekly foot traffic now down more than 5% from Walmart and nearly 9% at Target versus the same period last year. Both retailers have seen traffic fall gradually since mid-January, while Costco has reported a stable 6% growth in its year-over-year traffic. Much of this may already be reflected in the stock, with the shares up 40% over the last year and 14% this year alone, but if it continues, could help the company beat its 7% sales growth expectations. Zscaler Inc., ticker ZS, reports earnings Wednesday, with the stock lagging other cybersecurity names over the past year, but still one of my favorites in this space. Not only is the company expected to post 20% sales growth this year and next, there are several potential surprises that may not be reflected in the shares. The company's disruptor advantage in that transition to a zero-trust architecture delivered through the cloud drove an initial growth, and it's now leveraging AI to process over 400 billion transactions a day for that real-time threat analysis. Also, a deal I've been watching that isn't reflected yet in the stock price, the partnership with CrowdStrike integrating Zscaler's architecture into the Falcon platform. Our shares are a little expensive here compared to these other cybersecurity names, but for this persistent growth stocks, you're always going to have to pay a premium. Broadcom Inc., ticker AVGO, has been caught in that AI stock sell-off, now down 14% this year, but still up 55% over the past 12 months. The company reports its earnings on Thursday, with the market expecting 22% sales growth to $14.6 billion and for profits to jump 37% to $1.51 per share. The management will almost surely beat these expectations, but as many have done this quarter, could try to manage those future expectations through a more modest outlook. Shares aren't cheap here at 18 times on a price-to-sales basis and could drive the sell-off on the report. I would be a buyer of any dip here, though, as Broadcom remains the best exposed to that all-around data center build-out. While I do like SMCI on the theme for its pure play in-server demand, Broadcom touches so many of the data center components that it can't help but get a big chunk of that hyperscaler spending this year. Showing you the bigger picture here with the Sector Spiders sector tracker, 7 of the 11 stock sectors managed to close higher last week with strong gains in rate-sensitive groups like financials and real estate. And it is interesting that with that dramatic sell-off in technology, we didn't see the same level of pain in communication services. While the largest names here like Meta, Alphabet, and Netflix did fall, more broadly, media streaming and internet stocks did do well. Last week's losses in technology show how concentrated the sell-off is and provide a clue into how investors can protect their portfolios if that market corrects further. Utilities provided none of their traditional safety as the group gave back some of that AI-related run on its data center electricity demand. Now, interest rates will continue to come down if the market senses weaker economic growth on the horizon, and that's going to continue to boost stocks like financials, especially the insurers, along with those in real estate. Now, both sectors should provide a good hedge against further market weakness. Turning now to the broader stock market and whether it's a buy-the-dip opportunity or could be a stock market crash. As is always the case, a relatively minor market correction is causing investor pain in the hottest stocks. While the S&P 500 is only down 3% from its peak set on the 19th, stocks like Nvidia and Palantir have reached bear market territory, down 19 and 32% from their highs. Now, the bad news is that the market, and especially these popular stocks, still aren't cheap yet, trading for 26 times on a price-to-earnings basis for the S&P 500. That's about an 18% more than the long-term average and could see further selling. And the good news, though, there also doesn't appear to be a catalyst for a full-blown bear market crash or a pop in that AI bubble, so investors can't have the confidence in buying the dip over the next few months. Analyzing this, you have to ask, why are stocks suddenly falling? First, that DeepSeek news weakened the reasoning behind massive data center spending that is underpinning the revenue growth for a lot of AI-related companies. In Quinn and Turner's bubble triangle that we look at, AI has been the technological spark igniting the fire analogy for the bull market. There are two reasons I don't think the DeepSeek news is enough to crash this market thesis, though. First is that even if we do need far fewer chips for training the AI models, as DeepSeek has shown, we'll still need far more chips and compute power for model inference or usage of AI. The faster we reach generative AI and train different models, the faster the real AI boom is going to start. And second, though, the major hyperscalers, including Amazon, Microsoft, and Meta, have all reconfirmed spending plans for data center infrastructure, even after that DeepSeek news. Now, more recently, investors are coming to that realization that those market-friendly policies like tax cuts and deregulation are much further out than the policies that could hurt the economy, like deportations and tariffs. Now, rant all you want in the comments, but a smaller workforce from deportations and higher prices on tariffs will increase inflation and hit the economy. President Trump has largely backtracked on tariffs for now, but last week promised the postponed Mexico and Canada tariffs will hit this week, followed by more throughout the month. As always, the bond market is a tell on the economy here, with the rates on the 10-year Treasury plunging from 4.8% in mid-January to just 4.24% last week, as investors expect a slowing economy to force the Fed into more cuts. While I think stocks are likely to retrace to below 5840 on the S&P 500 for at least a 5% correction, it's still not cheap, but less expensive. Revisiting the bubble triangle model, we don't see the kind of catalyst that would pop this market. Investor sentiment is still broadly positive, with investors rushing in to buy the dip and willing to chase some of those stocks higher. We also know that this government is definitely not going to be pushing regulation of stock trading or market regulation that has popped bubbles in the past. Marketability of stocks is still increasing with fractionalization of shares, tokenization of assets, and lower tick sizes, and credit is still strong with trillions of dollars locked up in home equity and money market accounts, while the Fed debates on more rate cuts for the year. I know it's a lot of economics, but this is the kind of research you need to do when those questions about the market's health start to send stocks lower. You need to be able to analyze the bigger picture to see if it is the buy the dip opportunity or if you should wait out a bigger downside. We will see the monthly jobs report on Friday with expectations for 160,000 jobs to have been created last month versus a pace of 143,000 the month prior. Now, I expect we will start seeing that weakening jobs picture take shape over the next few months, which will weigh on stocks, but with renewed hopes for Fed rate cuts, shouldn't disrupt the bull market more than a 5 or 10% correction. Look in the description below for that video on our prior analysis on the allegations against SMCI, or other videos I've linked there, including this one on the right, 5 stocks to buy that will surpass your income. I'll lay out a real plan, how much to invest to replace your job. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.